Welcome to SS2 Agricultural Science, Term 3, Week 10. Farm business management is the application of business management principles to farming, planning, organizing, directing, and controlling farm operations to achieve the farm's goals profitably and sustainably. Every farm, no matter how small, is a business. Understanding how to manage a farm as a business is a critical skill for modern farmers and agricultural professionals. By the end of this lesson, you will define farm management and its objectives, explain farm planning and budgeting, distinguish between fixed and variable costs, calculate farm profitability indicators, gross margin, net farm income, describe farm records and their importance, and answer WAEC questions on farm business management. Let us begin. What is farm management? Farm management is the science and art of organizing and operating a farm profitably. It combines agriculture, knowledge of crops, livestock, soils, with economics and business, resource allocation, decision-making, financial management. The farm manager must make decisions about what to produce, crop mix, livestock type, how much to produce, scale of production, how to produce, technology, inputs, methods, when to produce, timing of planting, harvesting, selling, where to sell, markets, value chains. Functions of farm management: planning, deciding in advance what to do. The farm business plan is the key tool. Organizing, arranging resources, labor, land, capital, equipment, to implement the plan. Directing, supervising workers and coordinating operations. Controlling, monitoring performance against the plan, taking corrective action when needed. Goals of a farm business: primary goal, profit maximization, for commercial farms, or income optimization, for smallholder with multiple objectives including food security and risk reduction. Secondary goals: sustainability, not degrading land resources, food security, social goals, employment for family and community, risk minimization, growth. The farm plan: a farm plan describes what the farmer intends to produce over a season or year, how, and with what resources. It typically includes land allocation, which field for which crop, input requirements, seeds, fertilizer, labor, equipment, production calendar, when to plant, fertilize, harvest, marketing plan, where to sell, at what price. Farm budget: a budget is a financial plan that estimates income and expenses over a period. A whole farm budget covers all farm enterprises together. Partial budget, used when considering a small change to the existing plan, estimates only the cost that change and the revenue that changes. Enterprise budget, estimates cost and revenues for one specific enterprise, e.g. 1 hectare of maize, or 100 broilers. Components of a budget: revenue, income expected yield times expected market price equals expected gross revenue. Cost, fixed cost, overhead costs that do not change with the level of production, incurred whether the farm produces or not, examples, land rent, depreciation of farm buildings and equipment, management salaries, insurance. Variable costs, operating costs that vary directly with the level of production, examples, seeds, fertilizer, pesticides, labor, harvesting, fuel for tractors, also called direct cost or cash cost. Total cost equals fixed cost plus variable cost. Gross margin, gross revenue minus variable cost, does not deduct fixed cost. Gross margin is used to compare different enterprises, which is most profitable per hectare. Net farm income, gross revenue minus total cost, variable plus fixed, minus interest on loans. This is the actual profit. Break-even analysis: the minimum yield, or price, needed to cover all costs. If you produce below break-even, you make a loss. Farm records: farm records are written accounts of all activities, inputs, outputs, and financial transactions on the farm. Every successful commercial farm keeps detailed records. Types of farm records: field records, plot identification, crop planted, planting date, input applications, date, type, rate, yield recorded at harvest. Livestock records, animal identification, ear tags, tattoos, birth dates, weights, birth, weaning, market, health events, vaccination dates, disease treatment, production records, milk liters per day, eggs per week. Input/stock records, inventory of seeds, fertilizer, chemicals, feed in store, purchase quantities and cost, consumed quantities. Financial records, income records, all sales, crop, livestock, other expense records, all purchases, inputs, equipment, labor, cash book, daily record of cash in and cash out, bank records. Labor records, hours worked by each worker, tasks performed, wages paid. Importance of farm records, decision-making. Records allow the farmer to compare this year's performance with last year, identify profitable and unprofitable enterprises. Management, detect wastage, theft, inefficiency. Credit access. Banks and lenders require farm records to assess creditworthiness before providing loans. WAEC examination and agricultural extension demonstrate sound management. Tax purposes. Informal/commercial agriculture records are needed for tax compliance. Insurance claims, in the event of crop failure or livestock loss. Legal purposes, dispute over transactions. Farm accounts, the final financial statements, income statement, profit and loss account, total revenue minus total costs equals net profit or loss. Balance sheet, list all assets, land, equipment, livestock, crops in store, cash, and liabilities, loans, unpaid bills, assets minus liabilities equals net worth, the farmer's equity in the business. Depreciation, farm assets like buildings and machinery wear out over time. Depreciation is the annual charge for this wear. Example, a tractor costing N5,000,000 with a 10-year life depreciates at N500,000 per year. Key economic concepts for farm management, law of diminishing returns. As you add more of one input, e.g. fertilizer, to a fixed quantity of land, the extra output, marginal product, from each additional unit of input eventually decreases. This means there is an optimal input level beyond which adding more does not pay. Opportunity cost, the cost of the next best alternative foregone. If a farmer plants cassava instead of maize, the opportunity cost is the profit that maize would have earned. Comparative advantage, a farm or region should specialize in the enterprise for which it has the lowest opportunity cost relative to others. This is the basis of agricultural trade. Risk management, farming involves risks, weather, pest, disease, price, risk management strategies, diversification, grow multiple crops, raise multiple livestock species. If one fails, others compensate. Crop insurance, contract farming, guaranteed price from buyer, irrigation, reduces weather risk, savings and emergency funds. Farm credit, most Nigerian smallholder farmers lack adequate finance to purchase inputs. Sources of agricultural credit, informal, family, money lenders, cooperative society savings, microfinance banks, Bank of Agriculture, government input subsidy schemes, e-wallet, GES, commercial banks, a high interest, collateral requirement. Key points: farm management, science and art of organizing a farm for profit, involves planning, organizing, directing, controlling. Farm plan, what to produce, how much, how, when, where to sell. Farm budget, estimates revenue and cost, gross margin, revenue minus variable cost, net income, revenue minus all cost, break-even analysis. Fixed cost, land rent, depreciation, management salaries, do not change with production level. Variable cost, seeds, fertilizer, pesticides, hired labor, change with production level. Farm records, field records, livestock records, financial records, labor records, essential for decisions, credit access, insurance. Income statement, revenue minus cost equals profit/loss. Balance sheet, assets minus liabilities equals net worth. Depreciation, annual charge for wear of assets. Key economic principles, law of diminishing returns, opportunity cost, comparative advantage, risk management through diversification. WAEC questions: define farm management, distinguish fixed and variable cost, calculate gross margin, state importance of farm records, describe farm planning, explain law of diminishing returns with example.